You know, it's not crazy, and I think you just did it, Scott. Technically, so I think you're not the first, but
Yes.
maybe one of the most prominent yet to do it. And I think that's where we are right now. Which is, if you ask me what the biggest risk out there is, it's that the Fed has to do more than the newly priced market has already priced in to get control of inflation. When I look at the numbers on Friday, Scott, I see more to come from a whole bunch of different. I think that housing number is going to keep accelerating. I don't think they have control of the vehicle market yet, where they have inventories back up. I think that the whole wage spectrum of higher wages has yet to work its way through inflation. I was very sanguine about inflation earlier on as the supply chain disruptions persisted and people did not come back to the workforce. I've started to get more concerned about it. And I don't know where inflation is going to be in the summer, but I think it's going to be above where the Fed thinks it ought to be. And I think at that point they may have to do more.
It's like the president's problem, too. Right? He's got, I mean, it just reflects like the same sort of problem. He's got a booming stock market, economy's going good. Inflation's a problem, and his approval ratings are in the can as a result of that. Joe, you have a question for Liesman?
I certainly do. We're really not talking about the yield curve. So from everything that Steve is suggesting, Steve, do I have to now worry about introducing the word inversion once again back on the halftime show?
I think that you do. I think that that's a possibility. First of all, the behavior of the long end of the yield curve has confounded many of the smart people that I like to talk to. They don't quite get it. The Fed is going to be moving up over time, and I guess the best bet right here, Joe, is that they think the Fed is making a big mistake. But I can tell you what the Fed thinks, which is that they don't think that this economy needs zero interest rates. And when you look at what the real Fed funds rate is, which is you discount it or you subtract the inflation rate out, it's minus 6.8%. And that's lower than even it was under Volcker, which is to say that as inflation has increased and the Fed has stayed where it's in, it's gotten easier. It's pushed on the accelerator more. The Fed is more stimulative now than it was before, so it has more work to do.